change this morning. It is trading under $65 a barrel on Brent, 64.50 to be precise. And for this particular moment in time, it is basically up 10 cents. So somewhat of a consolidation in Asian trade today. Lots of noise in Asia, of course, with all of the trade conferences and ASEAN meetings. And of course, President Trump is out there apparently on the doorstep of doing some kind of a deal with China. But let's kick off this morning with the news on the other side of the world. Ilya Buchev, managing partner at Pentalon Investments. More interested to start the day, Ilya, about the Fed. Fed are due to announce again today the market expectation 100% of another Fed rate cut today, and even similar percentages for another cut before the end of the year. Your thoughts on the outlook for more Fed easing and what impact it could have for oil markets?
I think there is more or less a consensus about the upcoming cut, and I really don't have anything to challenge that. So basically, Fed is in a bit of a difficult position because they have a dual mandate, and we're actually diverging on both sides of this mandate. As you know, inflation is at 3%, but it's actually, if you look at the 3 months momentum on inflation, 3 months annualized, it's close to 3.5. So it's diverging on the inflation side. It's also diverging on the labor side. So they're in a tough position, but the labor seems to dominate today. So you almost need a bit of an insurance cut. And if you look actually carefully at the Fed dots, there is a consensus for the first 3 months on a gradual cut. I think they're going to cut today. They're going to cut in December, maybe one more time. There is a consensus on that. But beyond that, there is a divergence. So that divergence is roughly split into two camps. So one camp is saying after 3 months, we're going to go flat. The other camp is saying we're going to cut deeper. And that's pretty much what the market is saying as well. But it's a bit difficult, obviously, to forecast that far ahead because there is a lot of issues. Look, we don't even have the data. So with the government shutdown, there is so much uncertainty. I think almost the camp that is saying we're going to cut 2 or 3 more times and we're going to go flat simply because we don't know. If you really don't know, better
even
not
with
to do
these
anything.
cuts, though, Ilya, even with these cuts so far, and then we've had one already, and it's been the next two are very much expected. The oil market has been little interested in getting too excited about the easing cycle. It's not doing much for oil prices.
Correct. I mean, absolutely correct. I mean, if you really do get a spike in a real spike in inflation, I think it might get a bit of a more bullish flows because currently all the inflation hedging going into gold, and you see what gold is doing. However, and I've talked to quite a few of folks in the investor mandate. So at some point, you've made so much money on holding gold. I think somebody put a number last week, $17 trillion of profits in gold. So if you allocate it's just an unbelievable amount of money. So if you allocate, I think the number was there, if you allocate 2% of your profits in gold, that doubles the supply of gold from all mines in the world. So the amount of profits sitting in gold and other metals is staggering. So at some point, if you really start seeing inflation, then look, it's just a profit taking. Why don't we take a little bit of money and allocate into laggards? And what is a laggard? Oil. So to me,
Laggards is oil.
that hasn't. So for now, oil is a laggard, but at some point, it's purely portfolio management. If you're sitting on a pile of cash, well, why don't we buy oil too? Because at the end, it's a real asset. To me, that's a very potentially massive flow. It hasn't come yet, but to me, If inflation starts escalating, there will be buying, but unfortunately, it goes both ways, right? So if all
It
of a
doesn't. It
sudden,
doesn't look like. Let's welcome Walter Simpson, former managing director and CEO for oil and gas companies on the operating upstream side. Walter, it doesn't look like OPEC Plus wants to give any reason for money to come into oil because they are continuing to increase supply and sort of putting a cap on the rise of oil prices. Now there's reporting that OPEC Plus, which are meeting this Sunday, that they may actually once again accelerate their increases despite the weak demand outlook. Your thoughts on their continued strategy?
Good morning, Sean. Well,
Good morning.
it's an interesting one. I must admit, having supported prices for so long by controlling production, to take the handcuffs off and start accelerating increases is a slightly surprising move to me, if I'm honest. Wasn't what I would have expected. I'd have expected them to control it more. Prices are sitting, what, $64, you said this morning. A year ago, they were at 70. They've been heading in the wrong direction. Yeah, there's maybe been a little recovery this morning, but I guess the only thinking they can have is that they'll probably hover around the same sort of mark, mid 60s.
And where does this intersect, do you think, with new capacity, the ultimate ability to at some point you end up running out of idle capacity?
Well, yeah, I think you do. And as we've spoken before about it, I'm not sure there's more than a couple of million barrels of idle capacity in OPEC Plus remaining, but that's ignoring sanctions. What happens there? But that seems to me that there's a mixture of politics and physical capacity going on with it. And at the moment, they seem to balance each other out. Every time you get a little bit more capacity, some geopolitical trend curbs that. So, hey, it's very volatile at the moment, and I'm struggling to predict what will happen with it, I must admit.
Laurie Hatayan, MENA Director of the Natural Resource Governance Institute. I mean, while we have extra supply coming on the market that's sort of putting a ceiling on the oil price, getting too far away from its happy spot at $65 a barrel, we do also have sort of a geopolitical floor of as well, with what now seems every day a greater and greater stress on the ceasefire in Gaza, which one would have to call doesn't exist anymore if one is being perfectly honest. Laurie, your thoughts on where the geopolitical equation, starting with the Gaza Middle East outlook and then maybe Ukraine?
So good morning, Sean. Basically, as we always said, for what's happening in Gaza is not relevant for the market, right? It doesn't have the only relevance to the tension in Gaza is linked to Iran's reaction and how Iran could react, and therefore the reaction from the US and others on Iran and on Iran's oil sector, and how much they want to if you want, pressure Iran by new sanctions or by enforcing the sanctions. Therefore, it's just like it's a sad humanitarian story more than like it has relevance to the oil market. Then you go to Ukraine, which is more serious because of the sanctions, latest sanctions on the oil companies, the Russian oil companies. But interestingly, the market, like the first reaction was like, oh, this is serious. So there was a spike in prices. But then again, they were like, all analysis was like, yeah, but let's see if they will go through with the sanctions and the implementation enforcement of the sanctions, because we've seen other places where the Russian gas that was sanctioned, but still you saw ships going to Russia, to China, etc. So the word is for, are they going to enforce the sanctions or not? That's why you've seen like the markets going back to normal, kind of, especially that there were some statements from OPEC producing countries saying that if the market needs our oil, we're going to bring our oil. And even today they're saying that maybe we will increase again more than what was expected. So that these are like the messages that come to the market, which keeps.
Well, you also have some serious energy infrastructure being hit. The drone precision of the Ukrainian drones on Russian oil infrastructure is starting to have some tangible consequence.
Definitely. And I guess like, so the idea is like, okay, they were like the Ukrainian strategy plus like /US/EU, they were like, okay, let's put pressure inside, like hitting some infrastructure, precise, as you said, very precise. So it's not like amateurish, or it's not just like by accident. It was like well known where they're targeting in a way that would put pressure on Russia. And today, when you're sanctioning two of the most important oil companies, you're putting pressure on Russia so that you force the Russian government or the Russian president to come to the table of negotiations with less of what he wants. So the bar is high for him, and they want him to come to the table with less of what he wants, so that there is kind of a place where they can come with a compromise, and hopefully President Trump will end the war between Ukraine and Russia. Now he's in Asia, doing deals in Asia and ending wars in Asia and doing deals in Asia, and then of course meeting with the Chinese, I guess, leadership as well. So, but then he will come back to this Ukraine-Russia. It seems that President Trump is solving all problems across the world, but then you go back to Russia and Ukraine, and this is where it is still
certainly solving problems, and from a headline point of view, he seems to get the headlines without the delivery. And I suppose Gaza is once again Exhibit A on that. I mean, you can have a big summit in Sharm el Sheikh and nothing changes on the ground. Ilya, I wanted to get your thoughts. If the Fed cutting easing has little impact on the oil markets direction, what about a deal in China? It does look like when we had this sort of early October news that China was going to be imposing a blockade on the export of rare earth minerals, which of course are critical to the digital economy in America, prices dropped off quite a bit, and now have come back on the sort of sentiment that a deal will be done on China. Do you think the China deal, quote unquote, has already been built into the price, or if indeed they do sit down and sign on a piece of paper, that could be more bullish for the oil markets?
Sean, I have to disappoint you. As an oil trader, we almost don't care about that. We don't care about this, and we don't care about most of the other geopolitical things that's happening in the market now. You talk to 9 out of 10 times traders in the market. They don't look at this thing. So that market now is entirely driven by algorithms. So what happens in China, it's going to be just noise. So no discretionary traders almost left in the market. They are having a horrible year. They don't speculate on this. So they're almost on the sidelines. So I really kind of don't think it matters, and I don't think anybody knows.
What about, given that sort of lighter volumes, people are sitting on their hands, maybe even closing their books for the year? What does that mean for the curve structure? We did see similarly during this window of October, we got very close to contango as prices dropped towards 60 on Brent. Now it has come back a little bit to the mid-60s again, and backwardation as a bit of comfort. Where do you see the structure going?
That's important, because at the end of the day, and let me actually tie it. I see the question on the box, whether OPEC policy is a direct request of U.S. to keep the volume flowing. Yes, it's probably one of the components for sure of the OPEC policy. And there was a story today that they are considering a bigger cut. It's possible. It's not out of the question. And the reason, at least in my opinion, because, and I think I'm almost a little bit repeating myself last time we spoke when we were in the low. So I was calling that the market is not going below $50 no matter what. So it's actually not a bad idea to increase the production when the prices are low because we're not going further down. And the reason is, going back to your curve question, the reason is there's just not that many sellers left. So the sellers were predominantly algos, and we can discuss later why they do what they do. The only thing that you ask about the curve, right? So the curve is important because essentially, as you know, backwardation doesn't incentivize storage. If the curve does flip contango, that potentially can bring a new large scale seller in the market, which is a storage hedger. So you buy physical, you sell futures. It has not been happening yet because the biggest buyer for storage was China, and China really doesn't hedge. So that potentially could bring a significant amount of new selling in the market that can push the prices down because funds can't do it a whole lot. They have very limited bullets left, but the inventory hedgers can. The only kind of, and I'll stop here, why it's important for sure. The only caveat is there is a lot of oil in the water. So it's about over 1 billion barrels. And one point that I don't think many people recognize, all of that oil is hedged. In other words, when you have your oil in the water, you short futures. So that means that selling already happened. So you already pre-sold your
Yeah.
futures. So there will be no more additional selling for that oil in the water because it's pre-sold.
Walter, just picking up on that supply side, you've obviously been at the front end of building oil capacity, gas capacity through your career, and most recently in Oman. We're now coming to the end of a year where the average Brent crude oil price has been about $67, and little indication that it's going to move too far away from that for the average of the 12 months of 2025. What do you think the legacy impacts of that are for new investment into new wells, into new production capacity, as we've identified, as we come to the end of this 5-year cycle from the COVID crisis till now? We had a lot of idle capacity. Now that's dwindling. This year, 67 average on Brent. Where is that impacting investment in new capacity, do you think, looking into 20?
So, the long-term pricing is what drives your investment. It's thinking, how am I going to get a return on this? What sort of price should I do it? I'd say at 67, it's probably okay. I mean, it's at the bottom end, but it's okay. Maybe your deep water, very expensive developments, you'll start to have a careful think about that. And certainly for onshore developments, I'd say that's going to keep investing in them, provided people have the money. So I think this oil price is okay. As I've said before, it's not so much that everybody wants $80 or $90. It's nice to get, but it's stability around what the price will be that really matters. So if we could guarantee a $67 oil price going forward, that would make investment easy because people would be able to figure out what return they're going to get on their money. It's the fluctuation and the volatility that makes it really challenging.
Sean, can I make just one quick comment?
Please,
Because I forgot when you asked me about the structure, and it's very important. At the end of the year, producers hedge, and they hedge a lot. And the Cal 26 is now fluctuating around $60. So the moment you go above $60, there's going to be a massive amount of hedging, like Walter is saying. That's going to lock in the price for a year or potentially two. So they're going to get this certainty. So that's potentially going to dominate all other factors. So if the front spikes, the back is going to be kept at around $60 through the end of the year. And vice versa, if the front goes down, so when they're in contango, producers like to hedge more because they feel like they are getting better price than in the spot market. But to me, this is one of the most important factors to watch for the next months. $60 for the average Cal 26 WTI.
The WTI, of course. Laurie, you mentioned in your earlier comment there about the fact that within the context of Gaza and the terrible tragedy that is, that it hasn't had much bearing on the oil markets and still doesn't, even though it is a colossal human tragedy. But it has played a role in the wider geopolitical framework of the neighborhood. And you mentioned Iran and so forth. We had a conflict between Israel and Iran in June. I wanted to get your thoughts on where all these other dots are connecting at the moment. It seems to have got a little bit unclear. And I mean by that is like, where is Saudi Arabia now? We got MBS visiting Washington next month. We had the Israeli attack on Qatar. Where do you think the dots connect from the Gulf states aligned with or not? They came out very strongly in support of Iran during Israel's attack in June. Israel attacked Qatar since then. Your thoughts on where these big pieces connect?
Look, I think there is this pause that everyone feels that they need in the region after the ceasefire and after that agreement and the Sharm el-Sheikh agreement. And then it's time for people now to reflect on what happened and how to move forward, especially, as you said, in the security framework of the region. Definitely all eyes were like on, okay, what the Gulf needs to think about the Gulf sense, like the Gulf common sense was that we need to have good relations with Iran. And that's very important because that's the neighborhood and we need a stable neighborhood if we want to continue grow our investments in the region and build our economies away from the oil economy. And we do need an Iran that is able to fulfill its potential as well, because that would bring peace as well to the region, because we cannot all be happy and leave unhappy people in the neighborhood, because they will be spoilers. And we've seen 7 October. It was kind of that everyone was like having projects in the region, connectivity projects, all of that. And they were unhappy people that were the spoilers. And then after 7 October, the whole region has changed and it had impact even on the whole world. So therefore, the discussions with the US will be on this new security framework in the region, the role of the US in the region, at the same time, what the region...
We saw Qatar secure a sort of security guarantee of sort, I mean, from Donald Trump, not a treaty with the United States, but the president provided a decree of security for Qatar after Israel's attack recently.
And then everyone will use that attack to get what they couldn't get from the US, because the US as well needs all the Gulf countries as well. And it's, if you want, like that, everyone talks about that big battle between the US and China over resources and over future dominance. But to say as well, like there was this agreement between Pakistan and Saudi Arabia that was like under the radar. It happened and there were no implications on it. But it is important as well under that security framework and scheme that we could have other different alliances within the region that would kind of have kind of balance what Israel has done in the region.
Would you expect MBS, Saudi Arabia's de facto leader, to secure a similar security guarantee when he goes to Washington next month, like Qatar just got?
I guess that would be on the table. And then the investment part. I think he's more interested on the investment part, but he sees that securing a deal on the safety security of the region is important to secure investments as well in the region and in the US. And I think that will be, both of these things will be put on the table. And I think one more thing, I've been going around a bit, and this issue of the IMEC, the corridor, if you remember, before 7 October, IMEC was put like that corridor from India to the Middle East to Europe, was kind of thought about it, and then 7 October happened, nothing was happening. It seems that now it's picking up again. And then the Saudis are again kind of interested in that project. Because without Saudi Arabia, it couldn't work, because a big chunk of that, whatever corridor is, digital corridor, energy corridors, physical corridors, they all need to go through Saudi Arabia. That sort of projects would be interesting projects again for the region, for Europe, and for the US, and that needs safety and security. That's why, again, like putting investments and security on the table to discuss, I would believe that that would be the discussions that MBS will have
It certainly
in
would.
the US.
It would certainly put a lot of not only the security requirement for that level of investment, but I would imagine you'd have to start to move into a higher oil price range than we are at the moment. But that's another day's consideration. Let's go to the survey question and get a view here about the Fed rate cuts. What impact will continued Fed rate cuts have on oil markets through Q4? I think we can all agree, and most of the market agrees, that the Fed has baked in 2 cuts essentially before the end of the year, 50 basis points on top of 25 basis points that already happened. What impact will this have for oil markets? Will it be bullish? Haven't seen too much bullish impact yet in this easing cycle. Will it be bearish? Because ultimately it signals that the US economy is weak. If you cut rates, you're facing a crisis, unemployment, recession, I don't know. That's what they used to do in the olden days. Now they cut rates for other reasons, it seems like too much debt. But ultimately, will rate cuts be bullish or bearish, or little impact for oil markets through to the fourth quarter? Because that's as far as really one could see, I suppose. Walter, just picking up on your last comment, you mentioned there the sort of 67. No, not too bad. I'll take it. I'll build some more wells. And I think you gave that perspective, correct me if I'm wrong, but as somebody who previously was heading up a part of the national energy infrastructure and development of the Gulf region, where $67 is pretty decent when your cost of production is not so high. What about, would you apply the same analysis for your former employers, the global IOCs who are facing a similar price point? Where do you think this year of 67, we're seeing layoffs, we're seeing all sorts of the dark headlines in the IOC space. How do you think they're digesting a year of 67 and their outlook for investing more?
I think it'll be much tougher for the IOCs, I'm honest. As you go to the deeper water, the more expensive developments, it gets more and more challenging. So yeah, it's a question of where you have that ability to invest and what the price of that investment is going to be. And clearly onshore is a lot cheaper than deep water offshore. But a lot of the big finds these days are deep water offshore. So yeah, it's probably around the mark where you have to think very carefully for deep water offshore development.
What about shale, for example, which has obviously been the big issue in the America, or North America at least?
But shale's it's a subtly different game. It's been recycling cash. It's always been get the money, get the well drilled, get the production, and recycle to get more production from the next well and keep it going that way. And when money was freely available and cheap, that was a great model to get things working. Since then, money's become less available to investment in the oil industry in the US, and it's been harder. With lower Fed rates, will it start to come back again? That's a really good question. A really good question.
Does it make money more attractive? Obviously, it's cheaper. Do you take it and put it in the ground? We saw when prices, the price of money went to zero for much of the last decade, a lot of money went in the ground in the shale patch.
Yeah, but I think at these sort of mid-60 prices and the WTI's, at low 60s, it's probably a challenge. I'd say it probably needs a bit higher for those areas. But look, I mean, politically in the US, what matters? Interest rates and gasoline prices, 2 key factors. So that may have an influence in how easy it is to access money to get more oil production.
And we have a big election. One thinks and hopes we still have elections in America in a year's time. Those 2 things will be critical, won't it? Lower gas prices and lower interest rates. You'd imagine that policy will continue to be a critical one for the Trump administration.
Absolutely.
And the appointment of the new Fed chair will play strongly into that. Ilya, your thoughts, just to come back to the point you made earlier. I just want to get a bit more into the idea that the flows out of the gold profits, flows for the mutual funds, money coming back to an under-loved asset like oil?
It's a bit of a shortage of investable assets, right? There are two components. I oversimplified when I said reallocation from gold. There are two types of investors. One is a long-term, like pension funds, they hold inflation-sensitive assets. But the other one, which is potentially bigger flow, their positions actually very similar. It's a lot of this massive momentum funds that they own equities, they own bonds, they own crypto, they own gold, they own silver and copper, they own everything. So, but a lot of them by mandate have to be long short, so they have to be short something. That's why they're short oil. So you long everything and short oil. So you saw a little bit of it last week. When gold dropped and equities dropped for a day or so, oil rallied. So if you actually, and those funds are gigantic, they're by far the biggest driver in all financial markets. So if you got all this quant chaos in the global financial markets, they're going to start dumping crypto, dumping gold, and then buying oil. That's by far probably the only bullish factor that I see, and it could happen. So all of a sudden, you got a reversal of everything. So whereas gold coming down to earth, crypto is falling, equities are falling, oil is rallying. So you may see actually some bizarre negative correlation between oil prices and equities, which we haven't seen in the past.
Laurie, last word to you on the seriousness of the latest round of sanctions. We mentioned them earlier. The Americans announced on the two biggest oil producing companies in Russia, but also the increasing threats on China and India to continue import, if they continue importing Russian oil at the same volumes, that they could subject themselves to greater consequences from US sanctions. But the core of this, it seems to me, is where Europe goes. If Europe can't be convinced to cut off the supply from Russia, why should anybody else? And Europe's still importing LNG from Russia, and some countries even oil products from Russia.
Look, for Europe, we just had the 19th package of sanctions, which is on basically when it comes to LNG, they said like short-term contracts end within 6 months. And then for the long-term contracts, it's like by early 2027. It was supposed to be by end of 2027. So now they're ending it and by early 2027. And that's what they have taken. Definitely, and then sanctioning all the shadow fleets, etc. And this is what they have been able to do, like within the context, like not to create another like energy crisis in the region, in Europe, and not to create any political crisis as well, because they can handle all these multi-crisis contexts. So basically, that's what they've done. And then, so they're cutting off the Russian LNG import into Europe, and then thinking that that will be replaced by the US LNG, and therefore you would be fulfilling what President Trump wanted, to increase the LNG import into Europe from the US, and then putting more pressure on Russia to end the war. So now you have like sanctions, real serious sanctions on the oil sector, and then definitely Europe is
this time we're really serious. This time we really mean it.
This time President Trump wants to end the war, and wants to be heard, and wants to be taken serious by President Putin, and then let's see what will happen.
Oh, I'm not sure about that one. I think it's another one of those easy free headlines, and let's not do much about it. I mean, look, Iran has been under sanctions for years. They've been exporting record levels of oil. It's very difficult to believe we're not in another boy cries wolf moment. At least that's what the oil markets are telling us. And I think I would be in alignment with that. Listen, we got to wrap it up. Our half hour together is over. Brent crude oil, little moving today. Let's see if it finds direction over the coming days. But all the announcements due for the Fed and from out of Asia, certainly the big one to watch is the Xi-Trump meeting. Will there be some indications coming out of that? Laurie Atayan in Europe, Walter Simpson in the UK, and Ilya Buchev in the US. Thank you guys so much for your time this morning. Have a great day. All the best.
Thank you. Thanks very much.
Cheers.
Bye.
Thank you. Bye-bye.